Hello, this is David Buckiso, Managing Executive for First Commonwealth Advisors. I hope you, your family, and friends are enjoying a healthy and safe summer during these unique times. I wanted to reach out to thank you for your relationship and also share a quick update that I feel will inspire great confidence from you and your team. Your team of wealth management professionals pivoted and stepped up to provide help to process over $600 million in loans for small businesses throughout our community for the Paycheck Protection Program, ultimately trying to save over 80,000 jobs. These are the finest individuals that I've ever worked with in my 25-year career in wealth management and financial services. In my opinion, your team is different because not only do they provide outcome-based wealth management and investment solutions, but they leverage the full financial capabilities of the bank to provide deposit solutions, loan solutions, mortgage solutions, and other banking products during these unique times. Thank you again for your relationship. Those of you that may be watching that have not yet established a relationship, we hope you do soon. We look forward to serving you well into the future. I'm going to turn it over to Loyd Johnson, who has two quick market updates. Thank you.
Thank you, David. And it's great to be back with everyone. It is July 27th as we record, and stock markets are now positive on the year. Hard to believe after what we've gone through over the last few months, but that is where we are. And we wanted to share today a couple slides that speak to some of the concerns that we have about where we are currently, how fast and how far we've come from the lows we put in back in March. So let's share those with you right now. The first slide looks at the Fed balance sheet and its growth over the last several months. It's gone to over $7 trillion, more than triple the size from the 2008-2009 Great Recession timeframe. It's concerning because I think people have come to believe that the Fed will always be there in times of volatility to provide liquidity. And at some point, they're going to want to reduce that balance sheet and sell the assets that they've purchased and built up over the last several months. The second slide is a valuation metric for the S&P 500. It's called the CAPE, or the cyclically adjusted price earnings, a much better gauge than the typical PE because it looks at earnings smoothed out over longer periods of time. And it's high right now. It stands at around 29 or 30. And although it doesn't tell us much about shorter-term market direction, it's been very good historically in gauging longer-term market return, in this case 10 years. Where we currently stand, it implies a 10-year annualized return of around 4 to 6% in stocks versus the 8 to 10% we've come to expect. So those are just a couple of the many things that we look at that we believe can and do affect market performance in the shorter and longer term. And we'll continue to monitor and be back as warranted. Thanks so much.